Hello, everyone. Thank you for joining us today. My name is Pam Arway, and I'm very pleased to lead our discussion on how talent concerns are changing the use of equity. There is no shortage of urgent topics in the boardroom today, and among directors serving on compensation committees, the conversations that we have about pay and talent management are more intertwined than ever. Our decisions now, particularly when it comes to equity, can have long-range implications for the organization. And because there's so much upheaval in the labor market with inflation and generational expectations, we're seeing changes in how equity is used as a compensation vehicle. Today, Alap Shaw and Greg Steckel with Pearl Meyer will share some recent survey data that illustrates these shifting trends, and they'll talk about what they're seeing amongst various industries. They'll also share some ideas about how to effectively communicate your compensation committee's decisions around equity use so that your strategy is clear to shareholders, and importantly, the value of grants is clear to plan participants. Before we begin, the NACD educational team has a few housekeeping items to share, and then Alap will kick off our program.
Thank you very much, Pam. We have a few administrative announcements before we get started. First, I'll talk about the tools you have available in your webinar console. On the left-hand side of your console, you can see all of today's panelists and access their bios. In the top right corner of your webinar console, you can submit a question to be answered by our speakers during the program. Time permitting, please note that if you submit a question, you will be opted in to receive future executive compensation thought leadership from Pearl Meyer. And in the bottom right corner, you can download a copy of today's slide deck and access additional resources. Today's slide deck is also available on pearlmeyer.com at the URL on your screen. As always, a recording of the webinar will be available early next week, and both nacdonline.org/webinars and pearlmeyer.com. Your participation in today's live webinar earns you credit toward maintaining your NACD credential. NACD fellows and certified directors will automatically receive 1 credit for their participation. Please note that you must attend this webinar for at least 50 minutes in order to receive credit. Finally, we will have a few evaluation questions at the very end of the program, and we would appreciate your feedback, so please stick around at the end of the webcast to answer those questions. And now, I'd like to turn it over to our next presenter, Alap, to get us started.
Great, thank you very much. Now, I'm sure we're all very much aware that we've had unprecedented wage pressures in across all industries and in our sort of macro environment. And what that basically means is that there is significant pressure in the labor markets as well as with the stock market. So we've seen historic salary budgets going from a standard of 3% increases on an annual basis to 5% or even more in certain sectors. What that also has done is that there is putting pressure on other aspects of compensation, namely equity. And so what we want to share with you today is an understanding of has the equity environment also changed as dramatically as the cash and specifically base salary environment. And related to that, what we want to also focus on is an understanding of, is this truly a sustainable environment where we're just at a new norm in terms of where equity eligibility is, what is the size of equity grants, the cost associated both in a stock-based expense aspect as well as in a annual share usage aspect. Are all those working in concert to create a sustainable approach for most organizations, or are we in an environment right now where if we continue, things are going to, in a few years, be significantly unsustainable. And then lastly, we'd also like to focus on the communications aspect of increasing equity usage. Are the recipients that you are potentially including in your equity programs, some of them may be new to those equity programs, and do they have the right understanding of the instruments and how and the impact on how to retain people through a thought through communication strategy. So I wanted to start with just some slides on some data collection that Perlmeyer recently did, and we took a poll and collected some information on a few questions. The first and more sort of ever-present question was, has equity use, is it expanding? Are companies using more, are companies going deeper within an organization? And are also companies using more equity at current levels? So the graphic on your left, you can see about 70% of companies actually said, no, they're not going deeper in the organization. And however, the 30% is actually what I want to sort of focus into and talk about, is that 30% of organizations that said they are going deeper within their ranks. That's a pretty significant jump year over year from what we would normally see, and that from our perspective, that's telling us that there is some, similar to the salary pressure that we've all seen, there is some significant pressure to go deeper into the organization. And again, I think this, and we'll talk about this in a few moments, I think there's varying degrees of how deep you go and how pronounced the pressure is, depending on industries. The other, on the right-hand side of the slide, is that when you focus in on senior executives, and then below that team, are we increasing the value of equity grants when we're looking at new hires? And so most respondents said that no, that there is no real increase happening, but the fact that 30% or so of respondents said that there is an increase, again, I think a quite significant jump from prior years, and again, telling us that there is many organizations are putting a more granular look at their equity programs and trying to determine whether they continue to be competitive given the changing environment. Moving on to the next slide is that, so what this essentially means is that it will not be a surprise to anybody that the actual annual share usage is likely to go up. And so approximately 45% of respondents indicated that there's likely going to be an increase in their annual share usage, i.e. their burn rate, with most indicating that that increase is somewhere in the range of about 10% or so. But what's interesting is that to add on the fringes, that almost 10% of the respondents said that they may actually see a burn rate increase of about 20%. So what's happening here is a confluence of factors. One, increasing labor market pressures, but also decreasing stock price. We've had a number of clients talk to us about using, as an equity grant strategy, a more of an average pricing calculation, or putting a floor on a stock price in order to calculate their equity grants. And the purpose of those two strategies is really to mitigate the impact on the burn rate. we want to give a similar value to our individuals. However, at current stock prices, doing so would create an astronomical increase in our share usage and burn a significant number of shares in our pool. So companies are starting to think about using this sort of average pricing strategy or just setting an arbitrary floor in calculating these equity awards. So,
yeah, Alex,
Greg,
can I?
Please. I was just going to ask. What are you?
Yeah. I, just wanted to comment on burn rates, because that's something that compensation committees really do need to understand. And you can go on the wrong side of burn rates pretty easily with equity, and then shareholders get upset, and then you get, negative ratings from the proxy advisory firms as well. So you have to be careful about that. I just did also want to comment on your previous slide about increasing equity through the organization, and also the fact that equity grants are rising because there is a war for talent, and sometimes, within different levels or for different skill sets, we're finding for financial people, for tech people, you have to pay up, and oftentimes that's with equity, and then all of a sudden you find that you have compression at different levels of your organization. So then you find your tenured people are paid less than the new people coming in. So it's a bit of a quagmire out there, and it takes a pretty deft touch.
Yeah, no, that's an excellent point. Greg, what are your thoughts on paying up?
Yeah, I was going to say, I work with quite a few companies that are newly public, that are coming from having been owned by private equity firms for a few years, and not your traditional startups, but more mature companies that maybe have been done a couple of acquisitions while private and then take them public. And these two trends that we're identifying here of more people in equity and higher burn rates, I've seen over and over again recently for these new public companies, which is quite interesting. They're really pushing the envelope on trying to include as many people as possible in the annual equity program. They're willing to tolerate a little bit higher burn rate, but to Pam's point, not out of bounds so that we don't get in trouble with the proxy advisory firms. And even where they push and push and push and can't get everybody into the annual equity program, you've seen a lot more put in employee stock purchase plans as a way to deliver on this promise of broad-based ownership.
Yeah, and I'm also seeing it. I work a fair amount in the tech sector, and just to give everyone some context, we're seeing burn rates in sort of that 7-8% even. And especially this is for those newly public companies that have, whether they went public and, through regular IPO or SPAC, that have just seen a plummet in their stock price. So I do expect to see some pretty, eye-popping numbers on the burn rate. But but just one other point on this usage. So I think burn rate is one aspect. The other, sometimes not focused on as much, is stock-based expense. And so we're actually, in conversations with some equity analysts that I've been having, seeing a much more increased focus on looking at a company's stock-based expense. And this is happening not only in the tech sector, but the healthcare sector, across multiple industries. So I wouldn't be surprised if you don't have more earnings calls speaking and asking about the company's projected stock-based expense. Okay. So what we'd like to actually move into is a polling question and ask actually all of you. So Pam, do you want to?
Yes, so here's the question. How concerned are you about increasing stock-based compensation expense or increasing burn rates? Very concerned, somewhat concerned, not concerned. I'll just give you a
question. I was going to share, I think we have an ISS policy update, if I'm not mistaken, that is going to add a value-based burn rate to the equation as opposed to their traditional share-based, and I think that's similar to what you were talking about a lot. We're more focused on the value, whether it's accounting expense or a value-based burn rate to these broad-based equity plans.
Right, absolutely. So,
okay, so here we have it. Yeah, I mean, some people are very concerned or concerned. Not many who are not concerned. So this is an issue that everybody is, talking about. And I don't think there is an industry where you're not seeing inflation in compensation, employee compensation. So whether it's equity, whether it's base salary, whatever it is, we're all facing this situation.
Yeah, and I'm curious what the two of you think of it. I'm not particularly surprised by these results. I was kind of expecting the somewhat concerned to be the majority, because I think at least in the meetings that I've been part of in the boardroom, what I hear directors doing a lot is saying, look, we don't like it. It is high burn rate or stock-based expense, but we are dealing with some unprecedented times. And so we need to do what's right for the business and make sure that we continue to sort of have the team in place that we think is appropriate. So would that be similar to what the two of you have been part of as well?
It is for me.
I would say yes. You have to do what's right for the company, and you don't want to be too short-term focused and lose it in the long term. You need to be wary of investor sentiment and how you're going to fare and say on pay and those things. But at the end of the day, you got to do what's right for the company. And somebody I admire a lot says frequently, success is one person away, right? And so if you have the ability to get very good talent into your organization, it's going to pay off. So sometimes you just got to do the right thing.
Yeah, I couldn't agree more. And the other point I'll make, and I'll turn it over to Greg here, is that I'm also seeing and hearing, because and you'll hear me say this a few times on sustainability, is that many directors are actually asking the management teams, give me a better understanding of your entire engagement pie. So compensation is definitely one, and probably a very important one. But what else are we doing to engage our executives, our middle managers, our population sort of below that? What things do we have in place? So I think if you're not already doing that, it's a great question to ask the management team. How else are we sort of solving this labor market pressure besides just compensation? Because that goes directly to sustainability. We're not going to be able to do this for 2-3 years in a row. So, Greg, do you want to talk a little bit about Richard Stock?
Absolutely. So we're going to share a little more data with you from our recent survey. On this page, you'll see we've got a minority, again, that are saying that they're increasing the use of RSUs over other forms of equity-based compensation, so only about 10%. But we have a suspicion that this percentage has increased and may, in fact, continue to increase. And when we stop and think about why that might be, why would some companies be using more time-based RSUs. Some of the things that come to mind, of course, are just tangible value for participants, using fewer shares than stock options, less susceptible to stock price volatility. We've had a lot of that recently. Easier to understand, certainly less complex, than PSUs. I think what remains to be seen is whether any shift that might be occurring is really more related to COVID or the current labor market, and it's going to be temporary, or whether it has some staying power, as Alap had said earlier, in terms of a sustainable practice. Now, we all know the pressure that we face to make sure that all of our incentive compensation programs, including our equity plans, are performance-based. So again, we're not surprised that the majority of companies are staying with options and PSUs to really create that strong performance alignment. I will share just one quick story with you from a company I worked with for many, many years, and the CEO of the company just really always disfavored PSUs. He thought they were incredibly complex. He thought the annual negotiation process with the board each year on goals was not ideal. They changed the metrics every 2 or 3 years. They were a company that did a lot of M&A, so they had a lot of complexity, and they had a feast or famine approach in their PSUs. They'd go a couple of years with max payouts, a couple of years with no payouts, and maybe every once in a while they'd come in near target. And he actually put together a 10-year analysis for his comp committee. I mean, maybe we should have hired him at Perlmeyer, but he basically showed the value that was delivered on the PSUs with some payouts, no payouts, high payouts, no payouts over a 10-year period, versus if they had just granted RSUs along the entire 10-year period, and the value differential came out to be less than 5% in terms of what was delivered. So anyway, in his case, he argued that we could get just as good a performance alignment with something that's a lot less complicated with RSUs, and maybe there's some other companies that are thinking about moving in that direction. One of the things that came out of our survey was really, what's not happening. We know during COVID we saw some instances of shorter performance periods on PSU plans. We saw some companies going to shorter vesting periods under the logic that it was more retentive in the near term, that 4 or 5 years was too far out to be retentive. Maybe we should be at a 2 or 3 year vesting period. But in this latest survey, you'll see on these pages, not the case that it's happening broadly among at least the group of companies that we surveyed. I will tell you that I have some sympathy still for the shorter performance periods on PSUs in certain industries. I do a bit of work with restaurants, hospitality, travel and leisure, and a lot of these companies operate on a global basis where COVID continues to be an issue. The war in the Ukraine continues to be an issue for them. And so in some cases, I think there are examples where just a 3-year performance period is almost impossible to set a realistic performance target, and perhaps there's no reasonable basis to do a relative metric. And so, again, I feel like, a 2-year period on PSUs could make some sense as opposed to the more traditional 3. So a little bit of sympathy from me on the performance period side, but on the vesting period side, these are intended to be long-term incentives, and I think it's hard to argue that anything less than 3 years is long-term. In fact, you'll have a lot of shareholders tell you it should be 4 or 5 years. Anybody else have any thoughts or observations about these two topics?
Yeah, I do, but Pam?
Yes, thank you. So on the performance period, right, typically 3 years, that is an issue because it's just everything is so uncertain. So I have one of my companies that I'm on the board of has for a long time done 3 1-year periods. So they have a 3-year program, but it is recalibrated every year in terms of revenue growth. And while, the proxy advisor firms don't like that, and we get cited for that every year, it really does help the plans stay relevant in a changing market. Up or down, by the way, up or down, because, you can benefit from that on the upside too. So that just worked for our company, and we plan to keep it because it titrates it with the business.
Yes, I mean, I would agree. When you look at the data 95% of companies are probably on a 3-year performance period. And the thing about that is that it's important when especially when you have such a changing dynamic, to have the market data as an understanding, but really sort of make the decision based on what's necessary for the company. So for multiple clients, we've implemented shorter than 3-year, but also have looked at longer in case they could sort of weather a storm, if you will, if you had a longer performance period. So but I think what's important is to see if there's a way to provide balance. So Pam, that sort of 1-year performance period, I've definitely implemented that at multiple organizations, but also done a variation of that, which is you set a 1-year performance period, but the individuals earn at the end of the performance period, but it actually doesn't vest until 2 years later or 3 years later. So there's a longevity there, and again, a sustainability principle that individuals don't actually earn based on that 1 year. I mean, they don't actually vest based on that 1-year performance period, that it goes out longer. So I think from that perspective, that can help mitigate some of the impact that shareholders would have, concerns that shareholders would have. But obviously, it doesn't mitigate the whole thing. But these shorter performance periods, especially in these past 2 years, I've implemented a lot of them because it is just difficult. And that brings back to Greg, your story about your CEO. Frankly, I'm not surprised at that result, where the restricted stock and the PSUs have this fairly small differential in terms of value created for individuals. Frankly, and I think that's, at least from a tech industry perspective, I think that's one of the reasons that many of the tech companies out there continue to use restricted stock, is that the businesses tend to evolve so quickly that setting those long-term goals is difficult and can just be like banging your head against the wall. So I think it can be industry dependent, but also the point you are in your business cycle and strategy dependent as well. So we're going to move on. Please. Oh, no, go ahead, Tim.
I was just going to say it's, PSUs can be used creatively as well to drive the company's strategy and to get people excited about the future of the company, as long as you can properly explain it and you take the time to do it. So if you have a company that's really focused on, say, a metric of revenue growth, and there is a plan to get there, and you have your PSUs are tied to revenue growth, and the revenue growth results in share price growth, then people can understand how performance units are much more highly leveraged than restricted stock. So, they can get it, and then they get very excited about it, and then they understand exactly what they have to do to contribute to that strategy. So I'm a big believer in performance units for the right reasons. And of course, we're all in that environment anyway, because executives, I think if you have less than, now it's gone up to, I think, average is 55% at risk compensation. You get dinged for that too. But again, not to be repetitive, but I've seen PSUs be very kind of motivational.
No, absolutely agree there. Just a quick story is, in a meeting last week with client, and we were talking about that issue. The management team for the past 2 years has been resistant to implementing PSUs. They had a 50-50 stock option restricted stock program. Fast forward to today, options are all underwater. And in fact, if they had a PSU program, they probably would have gotten paid on hitting the results because the company is actually doing, pretty good financially. It's just that the stock price has not been cooperating. So interestingly enough, it would have been beneficial for them to have that, but they are implementing this year, so it's a good thing. One of the other questions that we asked in the survey is kind of an emerging trend that we're seeing with some of our clients. Again, not the majority, so the result here isn't surprising. But is the value of unvested equity being taken into account when you're making new grants? And the majority of respondents have said indicated no. But what's interesting about that is that we're seeing it more and more. Started with when the stock market was on a on a tear and valuations were very high. You had a significant amount of unvested equity, and I can show you this on the next page. Significant amounts of unvested equity in the hands of executives. So the question came up is that do we sort of have, are we getting diminishing returns by looking at market data each year? Saying that, philosophically, we want to calibrate to the 50th percentile and issuing a new grant of equity on an annual basis. The purpose of that equity is to engage the individual, retain the individual, encourage performance. But when they're holding, 10x their base salary in unvested equity, do you need to give more? So now, on the flip side of that, as the market is, now experiencing a downturn, that can, looking at unvested equity can also be something that is meaningful. Do we have enough holding power on our team? And I speak of executives, and because mostly the purview of the boards, but this type of analysis that you see on the page can be done throughout the organization. And really what you're trying to understand is that the chart on the left, one way of looking at it is what is that holding power as a multiple of salary? So that is just a good indicator of the magnitude of the unvested holdings. And the chart on the right is a good indicator of the buyout risk. So that's looking at that same number of unvested holdings, but as a multiple of a market median annual grant. So this chart on the right essentially tells you is that what would a competitor have to do above market to buy out an individual. And to illustrate the point of, sort of zero in on two individuals there, the chief marketing officer and the chief product officer. You can see chief marketing officer has very little, or I should say very high buyout risk, and the chief product officer has very little buyout risk when it comes to a competitor coming to the table with an offer. And so, Pam and Greg, I mean, is this something that you've done in Pam organizations that you're on the board for, and Greg, the ones that you serve?
Yes, and we do them for each company that I'm involved with. It's just to give you a degree of comfort that your talent, you're going to be able to retain your talent, or an area where you, as you pointed out, this chief marketing officer, where you could have somebody swoop in and pick them up, and so you have to make sure. I'm happy when the holding power of the multiple of salary is high, and I'm happy when it would cost other companies a lot of money to buy out our talent. So I think I like to see those numbers in green.
Yeah, I think this can be powerful as a sort of a once a year kind of dashboard for compensation committees. We'll always exaggerate that, look, we know there's lots of reasons why people stay. It's not all about compensation. So, just think about this as what we would call, equity-derived retention strength. So if we just isolate one factor, non-vested equity, do we have or are we building a substantial amount of non-vested equity value that somebody would be forfeiting if they walked away? I think that's a good thing to see. This example has sort of a roll forward over time. I think it assumes we don't make any additional grants or maybe just 1 year of additional grants. I don't think the outer years are as meaningful as just the year that you're in, which is to say, at this point in time, this is the amount of retention strength that we have. And the right-hand side, I think you never know what companies are going to do. So you can look at it as a buyout risk, but we all know that when somebody's coming after one of your best people, usually the sky's the limit in terms of what they'll offer. So whether you look at it in this kind of a format or you look at it as part of your process of reviewing tally sheets, this is probably front and center on most versions of tally sheets that will show you each executive's equity holdings and the value of those holdings in this same context. But whether you look at it one executive at a time in a tally sheet format or in a scorecard dashboard, like this, I do think it's an important piece of information for compensation committees to have.
Yeah, and the only thing I'll add to that, to both those comments, is that if you're not already doing this, and maybe you still don't see the value when it comes to your granting equity grants, I also use a tool like this when thinking about succession planning, because this also, if any of these individuals are on the list to be a successor to your CEO, or even as you go down in the organization, successor to those roles, it's a good indicator of what is your hold on that individual until they're ready to be the successor, and whether or not you need to put more equity forward to ensure that is happening. So that's another sort of outcome of or benefit of doing that analysis. Now I think we're actually going to move into a few more polling questions. So Pam, I'll turn it over to you.
Have you noticed an uptick in questions from employees about equity compensation in the last 12 to 18 months? Yes, no, or I don't know.
And again, here I think we're just trying to validate, the point as to, whether this is on the minds of employees or not. Usually a good barometer of that is whether you're getting questions from them about a particular topic.
Right. Yeah, and I actually don't know what the response here is going to be. I think it's on their minds, but I'm just wondering if it's bubbling up to the board level at this point. Should we take a look at the results? Ah, interesting.
Oh, that is interesting.
So, it's kind of split between no and I don't know and yes. For me, I don't know. It's not something that's come up in my boardrooms.
I'm surprised at the amount of yeses here. I don't know about you a lot, but yeah, over half of the folks with us today are saying, yes, this is, we're hearing an uptick of questions about equity-based comp. That's higher than I would have expected.
Yeah, I couldn't agree more. I am a little bit surprised that the yes is that high. So that's interesting that these questions are sort of bubbling up to the board level. Should we move into our next question?
Does your organization provide its managers with education material on how equity compensation works? So this is related to the last question. If you're getting more demand for it, then obviously you have to provide the people's managers with the ability to explain it.
Yeah, and I think what this will speak to is whether if companies are really taking a formal process versus an informal process. Because I can't tell you how many executives I talk to have been getting certain equity grants, for years, and they still don't fully understand what they have. So, having more and more communication on this, I think, is never a bad thing. So.
Well, that's good.
That's good. It's related. I'm glad for it.
Again, it's a little surprising. Here I was expecting a higher percentage of I don't know on this one, whether managers had information or not.
Yeah, these are some very well-informed directors. Good thing.
Okay. Well, that kind of parlays into sort of that last topic that we want to talk about. And, it really goes to the issue of, in many cases, may not be this group given the answer to the previous question, but in many cases, we feel like there's a real missed opportunity on the communication side to really maximize the return on investment in these kinds of programs. And what we mean by that is looking at the right-hand side of this page is, can you clearly articulate how equity compensation fits within your overall philosophy and strategy, not just for executives, where I think most public companies do a good job there, but really comprehensively throughout the organization. Again, we talked about earlier, maybe it's through an ESPP, maybe it's through a 401k matching stock. Maybe there's lots of ways to do or get equity into the hands of employees, but do you have a clearly articulated strategy and philosophy for your organization? The second check mark there talks about, providing the education materials necessary to make sure that not only the participants understand the plans, but the managers of the people who are participants in the plans are providing, good information, accurate information about the plans, the mix, how things work. And then that last check mark talks about, reinforcing through actions, behaviors, mentoring, whatever it might be, all of the key messages around equity-based comp. If I kind of take it back up to a 30,000-foot level, I think of it this way. It's kind of the who, the what, and the why of equity-based compensation are the questions that I think if you have clear answers and it's well communicated, you have a better chance of having a good return on investment from these plans. The who is in our equity program. Where do we draw the line for eligibility? How do we draw the line? How do we treat new hires? How do we treat promotions? So who's in this group of people that are eligible to participate in equity, and how robust of a criteria and a thoughtfulness do we have around answering that question of who is in the equity plan? The what question is what people tend to focus on, which is just what are we providing? What are the mix of vehicles? How does that fit our business? Is it competitive in the marketplace that we compete with for talent? So all of the traditional questions around what we're providing. Once we know who's in the plan, what are we going to provide? And then the big one is the last one, which is why. Why did we pick this group of people? Why did we pick this type of program with the design that it has? Why are we even providing equity-based compensation? Sometimes that gets lost in the shuffle as to the alignment of incentives with shareholders, creating wealth accumulation opportunities for our employees, providing some additional retention strength for the company. So the why of it all, you can answer in a lot of different ways from a lot of different stakeholder perspectives. But I think if you can really focus on that and, again, have a clearly articulated who's in the plan, what are we providing, and why are we doing it, internally, it maximizes your chances for success. And then you can take that same process and apply it externally to your public disclosures to explain the programs and hopefully keep yourself out of trouble with the proxy advisory firms, activist shareholders, whatever group you're most concerned about them weighing in on what you're doing. So the who, the what, and the why of equity-based comp. Don't just stop with the design, keep on going through sort of rigorous communication and disclosure. Again, I think it's the best way to make sure that all your design efforts pay dividends. Pam, any thoughts?
No, I think I was just going to say I think we're into the question period. So Alap, if you have a couple of closing words on this slide.
Yeah, just one. I just want to underscore sort of the why, because and this is one benefit of really emphasizing the why is that it creates significant engagement with the population. They understand that you're not just doing it because you're trying to be market competitive, but there's a reason why they're being included in an equity grant, and why that individual should value having something that vests over a long-term period versus just cash compensation, which materializes within a year. So I think that sort of emphasis on the why is really critical. So, but yes, let's move into the Q&A.
All right. So we have a number of questions, and I'd like to get through as many of them as possible. So I'm going to ask you to give your answers as briefly as you can. So the first question, which has been around since we started the discussion, because you started the discussion on stock-based expense. And the first question is, if your grants are dollar-based rather than share number-based, is the amount of stock-based expenses that you have, is that a real issue?
Definitely.
You want to take that one?
Sure, absolutely. Definitely if what you're also thinking about is going deeper in the organization. So the stuff, what we're seeing is many organizations, in order to compete, they are needing to go deeper. So then that's significantly increasing their stock-based expense. But if you have a steady state population and the market data is growing at a small rate, then no, it wouldn't have a significant impact. But we're in an environment where the market data is growing pretty astronomically, and we're going deeper.
Okay, well said. Thank you. Here's a second question. How have you seen equity grants rising for non-management talent? So I haven't seen that, but maybe you were both talking about that earlier.
Yeah.
Well, I think that one of the things our data suggests is that we've got perhaps more people being considered in the eligible population. So if the question goes to that issue of maybe people who haven't received equity before receiving equity, I think that's one way in which you could argue that more people we're increasing the use of equity for non-managers. The other is back to that issue of mix, right? I think when we have to really balance this issue of sort of alignment of the mix, up and down the organization versus at some level, should we be pivoting more towards the tangible aspect of RSUs, so that in the event that the PSUs have performance volatility and the stock options have stock price volatility, is there a level within the organization where we're not as focused on shareholder alignment, we're not as focused on performance alignment? What we're really trying to do is create stickiness or engagement. I think you could argue that the way to get those folks more value potentially is through a higher percentage of their grant being in the form of RSUs. But we can't lose sight of Pam's comment earlier that in a lot of cases it's the leverage of the PSUs and the options that really produce the upside opportunity. So definitely a trade-off between short-term, long-term, what's going to be tangible for certain people, and trying to make those decisions.
Right. And the other thing I'll say on that is that the other place we're seeing sort of an uptick besides just the eligibility is a greater use of inducement grants. Just as you've seen in companies sort of needing to provide greater vacation, higher benefits, things like that. We're seeing companies, even if you may not be equity eligible on an annual basis, to use equity as a way of inducing an individual to come to the organization.
Right. Okay. Here's another question. Quite relevant. What's the typical strategy with employees who have been granted options that are underwater? How and when are the best ways to cancel or reissue grants to keep them motivated?
That's a very tough one.
And stay in line with the law, right? Because you can't reprice.
Yeah, exactly. I mean, as I think we're all aware, repricing without shareholder approval is a big black mark on the company that actually follows you for years, and many equity plans actually disallow it. So I think it's a progression. First and foremost, and I'm going through this with multiple clients. First and foremost, we're starting to think about do we have enough shares to do an equity replenishment? One organization what they're doing is a lost value calculation. So they're looking at the grants that they granted over the past 2 years, calculating what has been lost in value from what was quote unquote promised on the day of grant, and making an issuance that tries to come close to that value, because they can afford to do so out of their equity pool. So that's one way, versus sort of not doing a repricing. But I think the repricing or something like that should really, in my view, kind of be a last resort, especially in a market like this, because you don't know if the bottom has hit in terms of the price. And if you reprice a certain number of options right now, you may still continue to have others that are underwater. So I think there's a few other things that you might want to look at before that.
I think it's also part of the answer here is that it's one of the reasons to maybe not use stock options at lower levels in the company, because the shareholder argument is going to be, look, we lost value. It makes sense that the equity participants lost value, and at the top of the house, I think that can be tolerated, right? People understand that. They're going to take a long-term strategic view. But for broad-based equity grants, when options are 30, 40, 50% underwater, that's a really tricky problem without a good solution, because the cancel and reissue doesn't work. The repricing, is typically prohibited or frowned upon. So maybe we don't grant options at some level to prevent this issue from occurring, just because the solution set is so challenging.
Right. Okay, here's the next one. What data should be used to determine and support going deeper in the organization with equity grants? So how would you make that decision?
Greg, do you want to answer that, or you want me to?
I'll go. There's a couple of things. I would try to surround it. I mean, one is to try to understand if the positions that you're thinking about extending equity to, if in the market those positions tend to be equity eligible. I think that's a good bit of information. You don't have to follow the answer to that, but I think that's a good piece of information. The second thing I would look at is the share usage or the burn rate implications from the equity plan. So if we take this down to our director level, if we take this down to our manager level, if we take this down to our senior manager level, whatever it might be in your organization, how many more shares are we going to be using, and what does that do to our annual equity grant rate? Is it still within a reasonable benchmark against our peers or the perspective of the proxy advisory firm, so that we don't get out of bounds? And if that all is green light, it's, these are typically positions that are eligible. It doesn't, materially impact our grant rate. I would start looking at the life of your shareholder approved equity pool. Does this mean that we're going to have to go back to shareholders to replenish the pool a year sooner than we thought, 2 years sooner than we thought? or really has no impact on how quickly we're going to have to go back to shareholders. And then to the point that Alap talked about earlier, I think just looking at the P&L expense associated with extending eligibility, usually as a non-cash expense, this doesn't get a ton of attention. But I think if you surrounded it with those factors, it would at least help you decide kind of go, no go, or how far to go in that decision of extending equity eligibility.
Yeah, and then, so Greg gave a good summary of the macro and micro things to look at. One additional micro thing I would add is turnover stats. To the extent that you have solid turnover stats, it might be worthwhile to take a look at that to see if it would help in terms of stemming some high turnover at lower levels in the organization. We've done that with a few clients, and it was actually quite eye-opening to see where doing some more equity lower down could have an impact.
Okay, well said. Thank you. So next question, this is an interesting one. Person says, I am concerned that employees are looking at equity as a short-term fix, in brackets, cash, to their need for cash instead of viewing it, whoops, okay, it just, I'm sorry, it just flipped away. Hold on a second. It was basically, are people looking at RSUs or whatever as cash, right, instead of long term?
Yeah, unfortunately, I can address that because I'm seeing it a lot in the tech sector. Unfortunately, they are, and I think that's actually a disturbing trend, because what we're seeing coming out of that sector is and it's been in the way for a while, is that you used to a 4-year standard vest, 1-year cliff, and then monthly or quarterly vesting thereafter for the remainder of the 4 years. So that the fact that you're doing this like monthly and quarterly vesting on something that's predominantly a restricted stock grant, it essentially turns it into cash. Now, the latest trend that's coming out of that is, because of the competitive market, is doing away with that 1-year cliff. And so, somebody signs on to the company in October, they get an equity grant, and they start investing in it immediately on a monthly basis. So now you've actually completely turned the equity instrument into a cash instrument. So this is where education can also be helpful, and so individuals can understand that if you actually held on to that, you could increase the value of it, pretty substantially. But also, this is where the sustainability comes into practice. We're no longer granting long-term equity. We're just granting, another version of base salary.
Okay. Okay. Here's we're going to take this last question, and then we're going to have to close it. Can you talk about how often companies are having to do one-off retention grants these days? These are traditionally frowned on by ISS and Glass Lewis, but current talent markets are so hot that many companies seem to be doing them anyway. So just a real quick, 10 seconds from each of you would be great.
I think it's a necessary evil in today's environment. I agree. You got to do what you got to do. And it's a punch that I think you can take. You can weather the storm on this one with the proxy advisory firms. If you absolutely feel like it's necessary to get the person in the door, it's probably the right thing to do.
Ditto.
Perfect.
Maybe we can turn it over to Sarah.
Yeah, and I happen to agree with both of you. So with that concludes the webinar. Thank you for participating.